We are starting to record now. So we're on to chapter 6. And I don't want to address any specific questions about the exam, but if you have some general questions, please let me know. If you have questions about specific questions on the test, you can email me, and I'll be happy to help direct you or get you an answer to your question. You should be able to go back in today and check everything out and make sure that everything graded properly. I highly recommend it. That way, as you go through, it can kind of help you study in the future. You can see whether or not you miss concept questions or quantitative questions, and you can tailor your studying. While this stuff kind of builds on that, I wouldn't say that if you did poorly on the exam, you're going to do poorly going forward. We are much more focused now on specific types of things, so there'll be less of a scatter shot type on the exam going forward. So chapter 6 deals with inventory, but we've already talked a lot about inventory, and we talked about inventory merchandising versus manufacturing. So for a merchandising company, you're welcome. Right, so merchandise inventory will typically have a merchandise inventory account or accounts if they want to separate it, but it's all kind of the same thing, right? A pen, you need a pencil instead? And then for manufacturing, they typically have 3 main inventory accounts. You have raw materials, work in progress, could be in process, same thing, or works in process, and then finished goods. Okay, and then when inventory is sold, it gets reported in cost of goods sold. Okay, so in the cost flows for merchandising, you have your merchandise inventory. Okay, so merchandise inventory includes, remember, the cost of the merchandise plus any freight. And then once that inventory is sold, the cost flows to cost of goods sold. For manufacturing, they have direct materials, direct labor, and manufacturing overhead, which direct materials, remind you, is usually raw materials. And so these three flow into work in progress. Once it's done, it goes to finished goods. Bless you. So if you have what you want to do is draw just arrows from pretend that goes to direct labor. Yep. Sure. Be right there. Oh, come on up here. I got one. Oh, they took your, here, bring this chair on. I left one up for you. So those three flow into work in progress, and then work in process flows into finished goods, and then from finished goods sold. So you remember the inventory equation, and this is just for, well, this works for any account, but these specific things, right? Beginning inventory plus purchases minus purchase, return, and allowances. Minus the cost of goods sold equals your ending inventory. And that can be rewritten if we're looking to find the cost of goods sold to beginning balance inventory plus purchases minus purchase, return, allowances minus the ending inventory equals cost of goods sold. Okay, perpetual means that transactions are recorded, bless you, in the inventory when they happen. So the inventory account is up to date. Whereas periodic inventory counts are adjusted at the end of the period. A separate physical inventory needs to be kept. Just waiting for everybody to get caught up. So I start seeing the pencils go a little slower and people looking at me, then I'll move. Okay. Inventory control here means multiple different things. When they talk about inventory control, one of the things that they're talking about is protecting inventory from things like damage or theft or spoilage. Those are just some examples. Properly inventorying. Yeah, let's just say counting. Properly counting the inventory at year end. And checking quantities throughout the year. And two, making sure that inventory is properly recorded in the financial statements. Inventory control is not the same as inventory management, but similar. In that inventory control makes sure the inventory is secure, protected, and accounted for properly. Inventory management is about quantities that are appropriate for the business. Now, this isn't necessarily talked about much in the chapter, but let's just think about what happens when we have too much inventory. So what are some problems when you have too much inventory? Right, so you have a challenge to sell it, right? Customers aren't buying it, so it's building up, and so you probably have to sell it at a discount. You have to warehouse it. And keep in mind, after the inventory is created, say for a manufacturing company, to ship it to the stores, to warehouse it, to store it, to protect it, those things are considered a sales expense, and it's expensive to store inventory. You have to pay taxes on the inventory. And there's probably more, but I can't think of anything else off the top of my head. What happens when we have too little inventory? So you could end up paying more for rush orders and things like that. What happens if those rush orders don't come in time? Lose customers, lose clientele. Could hurt the reputation. For manufacturing, may have to idle the factory, right? We saw a lot of that during the pandemic, right? Because the supply chain broke down. All right, so that's just a little side note to get you thinking about the analysis and why we do some of the things we do. Inventory management is important. Inventory control is to make sure that you have things accurate so you know how to manage your inventory. Any questions? Sorry, I'll leave that up so that everybody can finish writing, and then I'll jump to example 1. One of the things that's going to be consistent throughout is you need to be able to identify, what's an asset, what's a liability, what's revenue, what's expense, what's equity. And so this is just more about this. What type of company is Morgan? The manufacturing company. Excellent. Okay, so we're going to be looking for raw materials, work in process, and finished goods. And so we have to add those 3 totals up. And my answer, so that comes up to 183,000, or C. Okay, now office supplies, if you technically said, hey, go give me an inventory of office supplies, that would be something you could say, but keep in mind, supplies are not part of the inventory. Now, when you get into manufacturing, you may have things called indirect supplies. Those things get put into manufacturing overhead, okay? Keep in mind that they're not included in our inventory. Inventory is something that is going to be sold or produce something that we can sell. Okay, let's take a look at number 2. Okay, the company has a balance in inventory of 624,000 at the beginning of the month. During the month, purchases additional inventory of 7,653,000 and sales during the month of 9,873,000 with a related cost of goods sold on these sales of 7,389,000. What is EJ's ending inventory? So we have to go back up. We have to use our formula, beginning inventory plus purchases minus purchase returns and allowance minus cost of goods sold equals our ending inventory. I'm just going to put the formula again down here. Beginning balance inventory plus your purchases minus your cost of goods sold equals your ending inventory. So here, 624,000 plus purchases of 7,653,000 minus the cost of goods sold 7,389,000. And that's 888,000. Thank you, Ben. Or D. When you make entries for sales with inventory, keep in mind that they're always going to give you kind of 2 bits of information, right? This is the sales price, but it has nothing to do with the cost of our inventory, right? This is going to be whether it's cash or accounts receivable that you're going to get for that. And then you're going to have sales revenue. And then your cost of goods sold. So if we were to do kind of just a little mini income statement here, right? Revenue would be 9,873,000 minus your cost of goods sold, 7,653,000. Oh, this way. And that would equal what? Oh, you gave me the number. What's the description? What do we call that from our income statement? Gross profit, right? And so now give me that number. Okay, 2,220,000. Now, I just wanted to remind you guys of that when you have a sale of inventory, it's 2 entries. Okay, now you guys have a practice one to try. If you have any question on the notes so far, or you have a question on this one, just give me a little wave and I'll come over and help. If you're not sure about the entries, at least try to go through and get the 4 amounts. Okay. All right, so it uses a perpetual inventory system that tells us that our transactions are going to be in the merchandise inventory account. And so it says during June, the company purchased 150 units. So we're going to add that to merch inventory. And it's going to be 150 times 34 units. And so that's 5,100. Hopefully, if you didn't know the entry, you were at least able to come up with this part. And we assume that they paid cash. right? That's our credit for 5,100. It says during June, returned 6 units for credit. So we're going to get credit for 6 times 34. And so that's 204. We have to make sure that we move it outside of our merch inventory because we don't have it anymore. And that's credit of 204. And then it says we sold 125 units at $50 each. So again, we assume cash that we received 125 times 50. And so this would be 6,250. And a credit to sales of 6,250. And then we have to move that merchandise that we sold out of inventory and into cost of goods sold for 4,250. And we have to take it out of the merchandise inventory account of 4,250. Now it's not asked, but what is the gross profit on this sale? Anybody want to be brave? No, you're close, but you don't have to deduct this part of it because these are still in inventory, right? It's just 2,000. Excellent. So all you're doing is looking at it at this sale and saying, okay, this is what I sold. This was my cost of goods sold. So my gross profit was $2,000. Give you about a minute or 30 seconds on this one. Okay, it says which of the following inventories carried by manufacturers like merchandise inventory? And so that would be C, finished goods. And I'll give you about 30 seconds to do number 3. It says which of the following should be included in a company's inventory at the balance sheet date? So just a quick reminder, goods in transit, FOB shipping point. Legal ownership of the goods transfers when the goods are shipped. Buyer usually pays the shipping costs. FOB destination legal ownership transfers when goods are delivered and accepted by the buyer. Seller usually pays shipping costs, but can bill the buyer. Okay, so let's keep that in mind as we go back and we think about what should be included in the inventory. So this is goods in transit, which were purchased FOB destination. So this means they're on the way, but they have not arrived yet as of the year end. These are properly excluded. They should not be included. Goods received from another company for sale on consignment. So this chapter talks briefly about consignment goods. The accounting for it's a little complicated, and I don't know how much we'll get into that with questions, but when you ship something to somebody on consignment, you still own the goods. They don't own the goods at all. They sell it, give you your money, and then take a fee. But your inventory is always your inventory. So since this was received from another company, this is their inventory. And you would not ever have ownership of that inventory. So that is not included. Goods sold to a customer which are being held for the customer to call at his or her convenience. So this has already been sold. They're set aside. They're listed for the specific customer, and they are not included in inventory. This one, goods sold to a customer and shipped FOB destination. So we ship them, but they should be included in our inventory until they arrive at the customer's dock or wherever it's being delivered. And so the answer is D. Okay, here's another one, give you about 10 minutes or so. Indicate which of these items would be reported as inventory in the financial statements. If an item should not be reported as inventory, indicate how it should be reported. You guys can talk to each other about this. This isn't a quiz. Yes.
goods coming to us?
They're coming to us. We purchased them as a company. What are you guys doing on these back here?
So when it says like purchase, like we're purchasing them?
Correct. We're the company, yep.
Okay.
You're welcome. What do you guys got? At least. Okay. All right, you're getting some guesses in there. Good. Some of them are obvious. You should be able to tackle some of the obvious ones.
That's not what we're selling.
Correct.
Or shipping.
Okay, Josh? Good. Sure.
Going backwards.
That's
But,
okay.
On this, I'm still kind of caught up on, I could be just missing it completely, but when we get the cost of goods sold down here,
Mhm.
I'm not entirely sure how we're getting that 46.50 from what we know here.
It's the 125 at $34.
Oh, okay, okay, yeah, that makes sense. I don't know why.
I should have written it down. Give you guys another minute. And then we'll talk about them. Okay, before I jump into this one, I just want to go back. Somebody asked a good question, and I probably should have detailed this, and I apologize for not doing so. On the cost of goods sold, how that was calculated here, we sold 125 units, and we had a cost of $34. So I apologize for not detailing that, but that's where the 4,250 came from. Now back to practice number 4. So goods purchased FOB shipping point that are in transit. So this is going to be part of our inventory. Goods purchased FOB destination that are in transit, December 31st. This is no entry. These are excluded from inventory. Because they won't arrive until after the inventory date. Goods sold FOB shipping point that are in transit. So now we sold these goods shipping point. So the day that we shipped them, they became the buyers. And so this does not belong in inventory. This would be cost of goods sold. Freight charges on goods purchased. So this is goods coming in. They want you to assume that those are inventory goods. So this is inventory, right? Part of the freight cost for inventory goes into the inventory. Costs incurred to advertise goods held for resale. This is not part of the inventory. This would be advertising expense. Number 6, materials on hand not yet placed into production by a manufacturing firm. So this would be raw materials, which is part of inventory, right? So inventory, the specific account, raw materials. Office supplies is not inventory, has its own account, which would just be office supplies. Raw materials on which a manufacturing firm has started production, but which are not completely finished or processed. So this would be inventory. And the account would be work in progress. Factory supplies is not inventory. It would have its own account. Goods held on consignment from another company, so you'd have no entry. You might record a memo. But remember, a memo is not an accounting records, but you do need to track that you have somebody else's inventory. Costs identified with units completed by a manufacturing firm, but not yet sold. So this is all the costs to produce the product, and all of those costs go into finished goods. So this is inventory and finished goods. Goods sold FOB destination that are in transit as of December 31st. This is inventory. Any questions? Okay. So now we are talking about cost flow assumptions. And cost flow assumptions in the four methods to account for inventory. So specific identification would be that you track all costs for each inventory item separately. And so something like this is used generally when there's many different single products. So you walk into a car lot, for example, and there's 15 trucks on the lot, and they may all be Ford F-150s, but one's a Raptor, one's a Texas edition, one's a King Cab, one's a short bed, one's two-wheel drive, one's four-wheel drive. Do they want to record their costs all at the same price? No, because then you'd end up selling trucks at the wrong price. Some would be too high, some would be too low, and you'd get cleaned out. So you have to record those all separately. Things like diamonds, right? You can't just throw everyone together. Size matters, so you're tracking them individually. And this is the only cost flow assumption where costs and inventory flow are the same. This means when you sold item X, you sold item X. It's not there anymore. All right. Average cost, or called weighted average, takes the weighted average of all inventory available at the time to calculate a weighted average per unit. That weighted average per unit is used to calculate cost of goods sold and inventory. Inventory is not tracked on an individual level. The next one is FIFO, and that's first in, first out for accounting purposes. Inventory does not have to match the cost flow. Which means, let's say you're selling washing machines and you use first in, first out, but you have a whole stack of washing machines. Are you going to try to figure out what the first one was that you got in? No, you just take whatever one fits the bill, matches the order, and you send that one because washing machines don't spoil. Now you'd hope, of course, your food would be first in, first out, right? Pushing those older ones to the front, selling them so they can get new ones in, but it doesn't have to be that way. LIFO is last in, first out. And here, inventory doesn't have to match the cost flow. But this assumes that the last ones you just bought are the first ones, bless you, that are sold. So let's look at an example. Example 1. Okay, so here we're using a periodic system, and that means that we're doing things at the end of the month to account for inventory. So for number 1, we want to find the cost of goods available for sale. Remember, beginning inventory plus your purchases minus purchase returns and allowances equals your cost of goods available for sale. So our beginning inventory I'm going to multiply 5 times 20. And so that's 100. Our purchase, 9 times 12. And so I think that's 108, but I don't have the answer here. Someone check my math. Thank you. Okay. And so cost of goods available for sale equals $208. So now part 2 says cost of goods sold and the ending inventory using specific identification. So let's go ahead and look and see, okay, we sold Z2 and Z5. And then we sold Z1, Z3, Z6, 7, 8, and 9. and Z14. Okay, so that leaves us with 1, 2, 3, 4, 5 left. And so let's see if that makes sense. We had 14 and we sold 9, and so there should be 5 left, okay? So my ending inventory is Z4 and Z10 through 13. So that's 1 times 20, right? The unit price, Z4, and 1, 2, 3, 4 at 12. So we get 20 plus 48. And so ending inventory equals 68. Now, if I take my cost of goods available for sale, and I'm not writing this in bold for any reason, it just changed. That's 208 taken from above, right? And I subtract the ending inventory. Less the 68, then my cost of goods sold equals 140. Any questions? Oh, excuse me, on example 1. Okay, let's look at example 2. Okay, so this is a perpetual inventory records. What should be the inventory at January 31st using the moving average inventory method rounded to the nearest dollar? So this means that we have to look and say, okay, what happened? So this sale on January 7th is going to be separate from January 26th. If it was periodic, we would just add everything up and divide by that total. However, we can't do that. So we have to say, okay, what is in inventory on January 7th? And so we have the beginning inventory, and that's the 87,930, and our purchase Jan 6th. Okay, and so total cost of goods available on January 7th. I get 149,730. Okay. And so how much per unit equals 149,730 divided by, and we have 2 unit groupings. We have 9,000 in the 6,000. So we have 9,000 plus 6,000. And that equals 9.982 per unit. And so our sales on Jan 7th equals 7,500 times our costs per unit, which would be 9.982. And it comes out to exactly half, 74,865, right? Because we sold half. So our remaining inventory after Jan 7th is 74,865. Are we following so far? Okay, and I'm scrolling up a little bit just to show. Now we have a purchase of 8,100 units at a total cost of 86,751. So purchase Jan 26th. $86,751. And so cost of goods available for January 31st sale. We have to add those two up. Then 161,616. Okay. Thank you. And now to find our cost per unit, we have to take the 161,616 and we have to divide it by, we had 7,500 left, right? Because we had 15,000 and then we sold 7,500 and we're adding 8,100 from our purchases. And that equals 10.36 per unit. So then we sold on January 31st, 11,100 times 10.36. I got 114,996. Okay. And so this is our cost of goods sold. And so we have our cost of goods available minus our cost of goods sold. This is our ending inventory.